I think, Jeff, we will see some progress. The two sides, hopefully, will at least agree upon some kind of framework to begin negotiations. Obviously, there's a long path ahead of us, and that path will be bumpy. But at least some sort of temporary truce will be very helpful in the current very volatile capital market environment. So these days, as you know, the Chinese economy is showing some signs of weakening. Even the US economy has done very well so far this year, but in 2019, given some of the headwinds that are coming, the US economy will not be performing quite as well as it did in 2018. So the trade tension obviously has been the #1 concern on the minds of corporate leaders and investors alike. So I think at the upcoming meeting in Argentina on Friday, there should be some sort of agreement on a framework for the two sides to negotiate. Now, Donald Trump said overnight that it's very likely that he's going to impose further tariffs on probably $200 billion of goods. As you remember, currently the tariffs are 10%. Those tariffs would likely go up to 25% on January 1st of 2019. And then you have another $267 billion of goods as well, right? So it looks like, at least for now, increased tariffs are something we should be factoring into our business forecast and business models.
When you look at how much the markets have already taken on board, it is clear that China has felt the pain disproportionately in capital markets. The Shanghai Composite, I think, is off over 20% year to date. Some individual stocks like Tencent are down over 40%. And when you look at the measurement of the premium that the US enjoys to China at the moment, on a PE basis, it's something like 51% to the Chinese market. That seems somewhat unfair, that China appears to have taken the greatest pain from this row around tariffs, or is it about something else?
Well, you know, we have had a divergence in market performance this year. The US was doing very well up until the most recent months, and global markets, emerging markets in particular, have performed badly because of the pressure from trade, slowing economy, capital outflows, and also in the case of China, the country has been undertaking the deleveraging campaign for the past 2 years. So credit has been very tight, especially for private companies and small and medium-sized companies. So you have basically a tightening environment in terms of credit. But also on top of that, you have sentiment issues. A lot of investors and consumers are watching the uncertainties unfold. They're beginning to rein in their spending. So you remember, Jeff, if you look at the Chinese economy, 65% of the growth is actually coming from private consumption these days. And private consumption is the #1 driver for China's growth. Now, as consumers are seeing the uncertainties unfold, they're beginning to spend a little bit less. They're spending on cheaper items. So that is going to affect the economy going forward. Secondly, another part of GDP that's important is investments. So investments, very simply, fall into 3 categories: investments in manufacturing capacity, investments in real estate, and also investments in infrastructure. All 3 areas so far this year have been slowing down. In property, we know we had obviously very high home prices. The leadership has been clamping down on speculation. Real estate investments have been slowing. Manufacturing, you all know, a lot of the industries are in overcapacity. Therefore, those investments are also slowing. Plus, infrastructure, local governments have pretty tight fiscal positions. They don't have a lot of money to spend. So that's why a confluence of factors are contributing to the slowdown in the Chinese economy. And very interestingly, export growth has not shown much slowdown at all, contrary to people's beliefs. And that is because a lot of the exporters are front-loading their exports. They're rushing to export to the US as much as possible ahead of the holiday season, because come January 1st, tariffs are likely to go higher. So that's a mix of factors that's been influencing the Chinese economy.